Well, good day, my friends. Morning, noon, or night, wherever you are. I first will, I guess, have to apologize for not understanding what's going on with timing with between daylight savings time and UTC. So I apologize if our times screwed anybody up, but this will be recorded and preserved so you can watch it anytime after the fact. For those who are joining us live, really glad to have you. My name's Keith Allen from Material Indicators, and joining us once again, one of our community favorites, XBT3D, aka Sean. AKA Sean, and AKA a lot of other things that we won't say here. But no, seriously, Sean's been just a phenomenal contributor to the community, and we're all learning so much from him. And I don't know, I think a couple weeks ago we started talking about hedging, and the rumbling in the community was, oh man, we got to do a tutorial on that. So here we are. And Sean was kind enough to supply a bunch of notes for us. And so we put that together here, and we're going to dive into that in just a second. It looks like I've already got a bunch of comments before we even start. Oh, Veronica keeping us posted. And Veronica was, I think, the first member of the community, the first girl, the first member of the community to make me realize that probably screwed up the time. But glad to have you here. Looks like Fred is here as well. Hey, Fred, glad you're able to take a break and join us. And, you know, if you want to chime in anytime, please do. Again, it looks like we got a bunch of people joining us live already. I apologize for the timing. We will dive into this, and you will, of course, have an opportunity to ask questions at any point in time along the way. And if we should not be able to get to those, well, you can find Sean or myself in the community pretty much any minute of the day, evening or night or morning, in any given time zone. We're in there all the time. So let's just go ahead and chime in. Sean, again, I want to thank you in advance for all your help with this. I'm learning a lot, and I know that our community is going to benefit from this. And to be honest with you, I could have probably spent weeks doing more research, creating more slides and more graphics, and dressing this thing up more. But quite honestly, it's so apparent that we all need this. And it's really important that I felt like, okay, it's just time to get into it. So let's do that. So without further ado, we will go ahead and get this thing started. Of course, nothing we say or do in this video or anything that Material Indicators kicks out or shares should be considered financial advice. We are not financial advisors of any way, shape, or form. Please do your own research, manage your own risk, do your diligence, and please never, ever risk more than you can afford to lose. This is a high risk game, no doubt about it. If you like the content, we hope you will comment, like, subscribe, and better yet, join us in our community on Telegram. Many people here, of course, already members of that community. For those of you watching on YouTube or Periscope who may not have joined us yet, we invite you to do so. Here's the links. If you can't find them, go to Twitter at _algos, and you can find it there. All right, Sean, let's go ahead and dive into this. And again, thanks to all who are joining us. You will have an opportunity to ask questions throughout the tutorial. So first question is, what is a hedge? And quite simply, it's a form of risk management used to minimize or cancel out losses from trades that are moving against your desired profit targets. That's something that happens to all of us, no doubt about it. But I think many of us, certainly in our community, trade without this. Many trade in one direction. Many trade just spot without using leverage. And those are all things that we're going to dive into here, at least at a high level. If we go too deep on all of it, then we'll probably be here for 2 weeks. Why hedge? I think you nailed this. There's no such thing as 100% certainty in trading. You got to manage your risk, and hedging is a key risk management tool that can be used with great flexibility. And that is something that Sean is going to share with us. In principle, I think we all understand what this is, Sean, but is there a way that you can simplify this even more?
Yeah, I think fundamentally you kind of have to step back and say that, the vast majority of traders are going to be directional traders, i.e. they're going to say, look, this asset's going up. Our beloved BTC is going to run to 75,000. Therefore, obviously, I'm going to long it, spot leveraged. It doesn't matter. But here's the truth of price movement. And the truth of price movement is that you can't say that with certainty. You can say that with probability. So I can line up a bunch of indicators on chain, off chain, and all of this stuff and say that I'm 80% certain the Bitcoin's going to run, for example, to 75K. Okay. But what that actually translates to is that what that means is I'm 20% sure it isn't.
Right.
Okay. And so what you have to do in these situations, if you care about the art of trading or the craft of trading, and more importantly, your financial well-being, what you have to do is to say, well, what's my plan if I'm wrong? Okay. And that is risk management. And that's really what risk management is, which is to say, I can assign a probability based on all the tools that I use to something happening, but I can't assign a certainty. And therefore, risk management is, in the event I'm wrong, what are the consequences? Now, a lot of traders will use stop losses, which is perfectly fine. I would say, particularly on Bitcoin, and I don't really look at other crypto assets too much, it is an asset that is stop hunted a lot. And a stop hunt is simply to say, look, we're going to go up to 75. I know there's a bunch of stops. A whale. I know there's a bunch of stops at 52, for example. Therefore, before we go up, I'm going to go down, grab that liquidity, and go up. So a lot of traders end up in this situation of being right in their call, but losing money on the way because of stop losses. And this leads to some really bad behavior, which is to trade without stop loss or to trade without any form of risk management. Okay. And over the years that the people have been kind enough to teach me this stuff, and I've worked with other traders, what tends to happen when you don't manage risk is that it manages you. And I use this phrase all the time, and anybody who knows me from other groups I've been in over the years has said, if you're taking this position of not managing risk, it is simply a question of when you're going to lose all your money rather than if. So it's something that everybody should take seriously. And what hedging is an alternate to, or potentially a complement to, stop losses as a risk management tool for when the price just cuts through everything and wrecks you.
I can think of more occasions than I'd like to recall where that would have helped me a lot. And you made an interesting analogy, being 80% certain, which sounds good. Sounds like a high probability, but at the end of the day, you're losing 1 out of 5. And how much are you going to bet? How much are you going to bank on losing 1 out of 5? And
that's really important for people to get, because particularly bull markets tend to condition us to not manage risk. So if the market is unidirectional, other than the occasional stop hunt, which we've been unidirectional all this year and long before. We've been unidirectional effectively since the COVID crash. This thing has just gone straight up. And what that teaches people are really bad habits, because it went up yesterday, it's going to go up tomorrow, and if not tomorrow, if it goes down, it'll go up the week. So people tend to disregard risk management in strongly trending markets. And
there's been an ongoing narrative that we're in a bull market. So why are you panic selling if this dip or this blip is likely to recover? Long before we have a real turn to a bear market.
Yeah, and that's perfectly okay. And trade the trend and all of that, and I'm not against that, and so on. But I'm just saying that if you play that logically to its conclusion, where I'm not going to manage risk, at some point we will top.
Right.
Here, absolutely. 75,000, 250,000, and you're going to get so badly hurt that all the profits that you've accumulated are going to go to zero. So to trade without an element of risk management is, in my opinion, and I think anybody who's been long enough in this game and seen what happens to markets, all markets ultimately, is you're in the when not if, because I can be 99% certain on something. Okay, right. I can describe that. That just means, again, you have to invert that, which means I'm going to be wrong 1 in 100 times, and if that 1 in 100 times wrong is costing me everything from my 99 times right, well, what's the point of this?
Right, and if one of those wrongs is a black swan event, like you like to recall frequently, that's not an if, but a when. Okay, we know
it's always a when. Yeah,
right. There's always one around the bend. Just not sure which bend, and so preparing yourself for that, or at least mitigating some of the risk for those types of events, is important. And we're going to get into that a little bit more as we get through this a little bit further. So hedges are designed to reduce or cancel out losses. And in ideal situations, they can add to profits. Now, I think everybody probably understands how you would be able to cancel out losses if you're long, if your primary trade is long and you're hedging with a short, or you're trading in opposite directions. That's easy to understand, but adding profits on both sides, that sounds like it might be a little trickier.
It's a lot trickier, and it's certainly not something that you can do all the time. However, there are instruments, and we'll discuss a few of them later, that give you the possibility to do that. And we were discussing it before we went live, Keith. They're kind of derivatives of options, which are derivatives of Bitcoin. And there's no point going into the machinations of what these things are, other than what they can give you in terms of potential hedging options. So a lot of people don't use stop losses, again, because of the incessant nature of stop hunting. That's not great. And you can get away, and again, you can get away with it so long. A lot of people don't like to hedge because the truth is most hedges are going to end up with a reduction in profit. Okay, so I'm going to go, look, I was up 10%, but I end up net up 8% because I did 2% hedge. Well, do you want to know? That's probably a good thing. But there's also situations where you can manufacture options where you have a decent probability of your hedge winning as well as your primary trade winning if you're a directional trader.
All right. Well, more to come. So there are a number of different strategies, lots of different instruments, and this is where it starts to get a little bit more complicated. And by contracts, when we refer to contracts here, we're obviously talking about options moves. So you could do the same asset on different contracts doing different things. Same asset on the same contract, which I'm not sure is that something that's universally available, or is that like
in fact, I mean, the only reason the only exchange I'm aware who allow you to do this is Binance in hedge mode. Okay. So in hedge mode on Binance, you can be long and short on the same contract, on the same asset. So their perp contract, you can be long and short. You can have two separate positions, and again, that has some big advantages to it because you share margin and all this kind of stuff. But yeah, you can be long and short on the same contract in this space.
And is that specifically on a perp contract or
that is, I've only ever used it on a perp contract. I can't say beyond that, but I would imagine it applies to all their contracts.
Okay, well, since some people aren't familiar with the jargon and the terminology, can you explain or expand on what a perp contract is?
Okay, so I guess basics for, again, unidirectional traders, and if I'm talking down to people here, I really don't mean to. When I started trading, I had to ask these questions, and people were very patient with me because I'm slow. So first of all, long just means that effectively I'm taking a trade that's making profit when price rises. Short means I'm taking profit when price falls. Okay, so when you say long and short, it means that you're trying to construct a position where, regardless of price movement, hopefully you can squeeze some profit out. A perp contract is a derivative. So, but by which I mean it's actually a futures contract, and most futures contracts have expire dates. So you could say, look, I'm going to go long or short on Bitcoin June, and that runs away. And at June, the contract settles. A perpetual contract is identical, except there's no settlement date. It's open. It's like the spot market. It's always there. It never closes. And the price tracks the spot market pretty damn well. So it's an alternate to that. It has some advantages because you can be long and short, and you can use leverage. You don't have to use leverage. I have to stress that leverage is a great trader tool, and if it's misused, is a great way to lose all your money. But yeah, a perp contract is simply a perpetual futures contract. That's all it is.
Okay, so most options, I think that a lot of people are familiar with, have expirations, because we're always, we just had the expiration on the last Friday of the month, and that's something that we always tend to watch. So in a perp contract, there's no expiration. You can keep it open as long as you want. You
can keep it open in perpetuity, as the name implies.
Okay,
and to be clear, it's a futures contract, not an options contract. If you're trading options, as we're all aware, so on a futures contract, you don't have to wait for expire. You can exit. When you talk about options, there's what's called US and European style options. European style options say that if I buy a put or a call on that option, basically I can do nothing until it closes on expiration date. And this is why we see expiration date and Deribit and all these guys who are offering what's called European style options. American style options are slightly different because I can basically put them to the market at any point. So it's more like a classic trading a graph rather than making a decision that where you're going to be locked in for a time period. Personally, I don't trade options directly very much. I trade derivative of options, which we're going to get into, that are freely tradable at any point in time because that suits my trading style. So I will trade forms of options contracts where I can buy now and 10 minutes later I can sell. So
right.
Just for people looking at options or derivative of options, it's not a question of being locked in until expire. Those option contracts exist. I personally don't use them or have a lot of experience in using them. Okay.
Well, let's cover some more of that terminology that we're gonna be discussing here today. Fading, we hear you say this a lot in the community. Building a position counter to price direction of the market via multiple entries, producing a dollar cost averaged entry price. This is essentially dollar cost averaging that most people I think are familiar with.
If the price is rising and you're in a market fade, what that means is that you're actually shorting the market as the price is going up. So you're going, okay, the price is going to run to 75, so I'll have key levels that I'm going to add to my short and drag my dollar cost entry up along with price.
Okay. And if you're long in the market, I guess this could go both ways, right? There are breakout traders who buy breakouts and maybe start with a large, if you're buying the breakout going up, you start with a larger position and kind of, invert your pyramid. Well, actually don't invert your pyramid. So you're building a foundation. And then as you reach new milestones, you may add to your position, but smaller, in smaller portions. Whereas in the opposite direction, you may open a position with a small percentage of your full position. And as price goes down, you add to that position, and you can step that down and step that down.
People are doing this buying the dip,
right?
Okay, and they're building a position. They're fading the market. So the price. Right. So what's happening is the price is coming down, and they're trading against the price with multiple entries, trying to build a solid dollar cost average. So fading the market is simply saying that, look, if it's going up, I'm fading short, and if it's going down, I'm fading long. If you, and I just say a slight aside, so if you consider like a really simple method of risk management in this, so you go, look, I'm going to sit here at 60,000, whatever, well, we haven't broken 58,000 bucks, okay, and I'm going to long to 75k, and I keep saying 75k, not advice. Trust me, I haven't a clue. I have years of demonstration of showing completely wrong on all my calls. But I'm picking a number, 75, okay?
Right.
So the price is going up when I'm long in it, okay? So a simple way to hedge your risk on that, because we're all, here's the mind game trading. I'm long. Everything's wonderful, yeah? But now my profit has got so fat, I'm going, geez, do I close a bit of it here or what do I do? And so rather than doing that, what I would do is fade against that. So I go along, the price is going up, and I'll start building a short.
Right.
Okay. And then what I'll try to do is to close my long somewhere near the top, nice profit. And now and if it does jam in the meantime, I'm covered.
Right.
But then I can also have the option to my faded short can either act as a cover to a dump, okay, or it can actually itself turn into a profitable trade. Because everything moves in waves and cycles,
and you can still fade in both directions with either
either
one.
You take that example, and again, I know this sounds easy, and trust me, there's a lot to it. But simply, I've got my initial call right. I'm long Bitcoin. I'm fading it at levels. At some point, Bitcoin's going to turn. I hate to say it, it's going to come back. Okay, I don't want it to, but it will. Okay, and I faded a short, and it comes down. I'm now taking profit from the short, but I'm fading a long position. So you can this concept of being unidirectional, particularly in longer time, or being bidirectional, particularly in long time frames, you still need to call near tops and bottoms. But what you do is you mitigate the need for stop losses. This is key, because a big jam you got covered.
Right. So you're essentially trapping either your profit or trapping your loss wherever it is, right between.
Yeah, you're never. There's this term, I think it could be in the slides, called naked trading, which again is where I think just about everybody who starts trading, and it's not naked trading. Just means you've picked a direction, you've shoved your chips across the line, and if it doesn't move in that direction, you're going to take a loss. Whereas covered trading, and now I think about it, covered, naked, it's kind of, I don't know where the terms come from. Basically,
I think it's being exposed. I could have gone with any number of graphics here, but I chose to keep it clean. We're a family show.
Yeah. So again, and again, there's a lot of detail in this, but if you think conceptually that when you look at the chart, you kind of have a pretty decent idea that it's going to go up. And therefore, and again, we come to this, instead of taking profit, fade it, because it gives you options.
Right.
Okay. So as it goes, it doesn't mean that I've done this for years. And again, my own personal situation, I'm spot long Bitcoin forever. I currently have a short with a dollar cost average of 45 grand, which to most people would cause gray hair. I have gray hairs for different reasons, by the way. And I'm going, no, that's a cover against a long position. So, we hit 75K or 100K, I'm going to add to it. So when the market swings down, which it eventually will, and hopefully we go to 100K and pull back to 60 or whatever happens, okay, I have lots of options here to make profit bidirectionally. And I don't have full risk exposure naked, i.e. exposed in one direction.
All right. Hey, just real quick, just a quick shout out to Veronica and Davey and DJ, Franz, Alex. Thank you all for joining us. Peter, good to see you here too. Sean. And for anybody who's just joining us or joined in late, my name's Keith Allen, XBT3D, aka Sean, also joining us here on the tutorial. And if you missed any portion of this, we will be, archiving this on the YouTube channel, so you'll be able to get to it and watch it at any time. We welcome any questions along the way, as well. And also want to remind you, if you are not yet a member of our community, we invite you to join us in our Telegram channel. You can get those details. Well, they're right here. If you don't have a chance to write that down, go to our Twitter channel at mi_algos, and you can grab the link there. If you like the content, please comment, like, share, and subscribe, and we will continue to do these types of things. Remember, of course, none of this is financial advice. Let's keep this thing going, Sean. We've got a lot of ground to cover here, and want to get through some of this terminology. So we just discussed naked trading. Let's talk naked versus hedged. Naked, you just said you're trading a single position with nothing to cover.
Yeah, and that's the point, that you're directional. And again, if we come back to, me being 80% certain of a price direction would be way beyond my normal level of confidence, but it still means I'm wrong 1 in 5 times, and that's really important to consider when you're pushing chips around the table here. So, and again, we're in a unidirectional market. That is training people to ignore risk management. And I can't repeat this enough. The market changes very, very fast. And so, stop losses are grand, and except in crypto, particularly, they tend to be rather hunted and upset people. So I would say that rather being naked, as in exposed to a direction of trade, okay, be covered or hedged, using some of the things we're going to talk about. And this is a world of complexity, which we're not going to touch on, just trying to get some basic concepts in here.
And in simple terms, when you're trading that one position, when you're naked, you really only have 2 options. You can, if the trade's going south on you, you can place a stop loss and take your lumps and realize a loss. And you can DCA or fade, and that can be very effective. I can tell you that I have rescued trades deeper than I should have ever let them go. However, didn't rescue all of them, and that can and will go against you. And what can inevitably happen if you're not managing your stack well is, you could be thinking, all right, it's got to bounce from this next spot. Here it is. I'm going to place my last bit on this next level, and then it shoots past you 5%. So it can eat your stack. You really have to, if you're going to DCA, you have to have limits to how deep you're willing to go. And if you're going to constantly DCA a long or a short, as a long-term hedge, I guess you could take that almost in perpetuity until you figure out what you want to do. But in terms of shorter term trades and swing trades, you need to have some thresholds, of where you're going to go.
There's a great question from Sean, a fellow Sean, in the chat, and going, look, what's, well, if you're long and short, what, obviously you're not making any money, but I'm maybe not describing it well. If I'm fading long at the same time I'm fading short, okay? So as the price goes up, I'm building my short, and as the price goes down, I'm building my long. What happens is the dollar cost average for my short will end up above the dollar cost average for my long. Okay, so by fading, by DCAing, I'm separating the short, I should say, which is, let's say, just to keep numbers simple, the short's at 50,000 and the long's at 40,000. Okay, just by fading in both directions.
Right.
Okay. And what that means is that there's no price, and if they're equal, just for the sake of it, if the trade values are equal and they're separated by $10,000, there is no price that Bitcoin can move to that I'm not in a net profit.
Right, because you've trapped it in there.
You trapped it in there, and you can continue to play this game. And obviously, if you're just going to do that, close it and run with the money. But this idea of non-naked, like, kind of sledgehammer trading, it's fairly brutal hedging, I should say, is that your dollar cost. So if I start today and we're at 58,000, then I just take a long and a short. Well, guess the news, I've trapped nothing. Okay. But as the price goes up, I add to my short. As the price comes down, I add to my long, and I'm separating these dollar cost averages. And if I continue to do that, my risk exposure, as in my net position, okay, will continue to grow in profit.
Right.
So I'm now not naked, okay, and whatever the price does, I can be. There are times, obviously, where I'm in balance, where my short's going to be bigger than my long, or vice versa, okay, but that's just a bit of trading nous. But the idea of using fade to build these positions in a smart way means that whatever happens to price, you don't have to put a stop in. And when it tanks 20 grand because some Asian whale goes, I want to fuck with you, you're not stressed. You're going, well, I don't have a stop loss.
Right. That makes
Great.
sense. All right, I got a couple more terms we want to just make sure everybody understands before we get deeper into the hedge part.
Sorry about the beer, by the way. I'm enjoying it.
So I think in Ireland, isn't that considered juice?
Man, you know, the sun's past the yard arm. You're gonna have a
That's okay. Leverage, and Sean just touched on that. Leverage is, you know, obviously when you are using your collateral to get margin to trade against. So we hear all sorts of crazy numbers, and we see people getting liquidated frequently, and this is something that I think is what a lot of newer traders and even experienced ones are scared of, getting liquidated, and that's why a lot of people avoid using leverage and trading on margin.
Yeah, I mean, margin is probably one of the most fundamentally useful tools a trader has. However, the exchanges give you enough rope to hang yourself. Okay, so what is margin? I have $1,000 in my account, and if I'm on BitMEX or let's say Binance, okay, more or less, Binance will allow me to trade $125,000 of trades with that, yeah, 125x leverage. So with one tick against my position, I'm getting a margin call, and I lost my $1,000. Now, that's not a responsible use of margin. Okay. So can you be a complete idiot with margin? Absolutely, yeah, but only if you're a complete idiot. Okay, so I only trade margin. Okay, my average margin on the stuff that I do with all the algo crap that I do is future contract for all kinds of reasons in a leverage that is sub spot.
Right.
All the time. Okay. However, I can construct long short positions. Certainly something that takes lose all your money. Click the 100x button. Okay. And roll the dice at the casino. Okay. But if you use it responsibly, I'll give you an example of where I would go sub spot. I over 1x leverage, 20% in a direction. Yeah.
You froze on that.
I'm quite happy being
Sean,
to it.
You had a little glitch on that. Say it again.
Bitcoin goes
still. All right, guys. Hopefully this kicks back on. Okay, so
Sarah at this end. Oh, it's back.
Okay.
Okay, so maybe just say refresh.
All right. So
it's died again, Keith.
What's that?
Seems to have died again. Oh no, hang on, it's back.
All right. Let's see. All right, guys, we should be back on. Let's see if okay. Frederick just got back in. Okay, Veronica is back. All right, guys. That's a technology glitch, and I'm happy to say that one wasn't on us. So normally it's me who screws up and can't share a screen, but this time it's actually sounds like YouTube had a problem, which means it could be Russian hackers, and who knows what's next. In any case, we're glad to have you back. We apologize for the technical glitch. I didn't kick out a plug or anything. Everything's good here. Let's get this thing back going again and see. Let me just get to where we left off. So for those of you who are joining us back, we're glad to have you with us. If you're watching the recorded version, we just went through a temporary technical issue, and we are back talking about hedging, and we discussed naked versus hedged strategies and a number of different hedging strategies that we're about to dive into. A hedge in loss when your trade is going south, a hedge in profit when you're already profitable, hedging spot longs, hedging scalps, and hedging swing trades. Now, I'm sure you guys are going to have questions as we get through this. Feel free to chime in. And hey, Noble Country Living, glad to have you here. Grove, good to have you with us. Pete, thanks for coming back. And let's see. Time to get into the big stuff here, Sean. So let's start with a hedge and loss. This is what I think most people think of when they want to hedge, is to protect those losses. So as you touched on earlier, rather than close at stop loss, you can hedge by opening a counter trade at your stop price, so that you are basically long and short at the same time and freezing the value of your stop loss right where it's at. So the trade could go down. It could go another 50% south. You're not going to lose any more money.
No. And again, a lot of people say, well, why the hell would you do this? Because basically you've just frozen your position. And the simple answer is that it gives you options. So as once you're stopped out of a trade, you have no options. Yeah, your option is to re-enter, take your beating and move on. Okay.
Right.
So a really simple thing for people to consider, again, is to say, well, I can hedge a loss. So I go, look, I have a rule. I don't like these rules, by the way, that if I'm down 5%, then I'm going to kick the trade out. It should actually be your stop losses. If you're going to use them, and I'm not against stop losses, it should always be market rational, as in if it breaks this support, then, this kind of stuff. But anyway, you've identified a place where you go, look, I just got this trade wrong. Okay.
Right.
Now you have the option to realize the loss, as in hit a stop loss and do that. Whereas a really nice alternative is just so if I'm long and the price tanks, and rather than hitting a stop loss, I will open up a short that traps that loss. Okay. Right. Then I'm going to walk away. Okay. And I'm going to let the candles develop and see what happens. Okay. Maybe there's more information, and maybe now I can manage these two positions. Here's the point. I'm no worse off than I was. Okay.
Right.
And in fact, since perp contracts, which is where you'd be shorting, by and large are always paying shorts, well, guess the news, I may actually recover some in funding. It'll be small and marginal. But the point is that rather than this, instantaneously out of it, and then, it's just a stop hunt or whatever, all of a sudden it gives me trader options. So again, it's just a simple thing to consider in terms of now you got to be, like anything, you've got to be careful here and you don't go wild, but for example, if you see it go down another X%, and you say, oh, it's hit this support and it's going to bounce, well, I'll close my head short here, and I'll make a certain amount of profit, and I will close my long on the bounce. Obviously it's going to lose money, but the loss that I would have had because I closed my short on support is going to be lower. So I can manage losses better. But the point is I have options. And that's really important, yeah, that it's not just I'm kicked out, I'm gone. Because your worst case position with this strategy is exactly what happens when you hit your stop.
That makes sense. And I what I really like about this whole concept is that you're giving the PA a chance to develop. So you're now not making an emotional decision. You've given yourself a waiting period, a cool off period to see how price action develops, to give your emotions a chance to filter out of the equation of making the decision. And, we see this happen with every single trade. How many trades? Oh God, this is going to be a big number with you. How many trades have you closed, whether in profit or at a loss, and a day or two later gone, fuck, because it reverted or it went even higher, whatever the case may be.
And do you know what happens there with traders? They stop using stop losses.
Yeah,
which is the worst possible thing you can do, because that 1 in 100. Hasta la vista, baby.
Yep.
Okay, so I'm not anti stop losses. I'm saying this is an alternative to a stop loss. But my God, if you're playing this game long enough, okay, where you don't exercise some form of risk management, it's when, not if. So I'm saying that as an alternate, this is about giving yourself trading options, saying, look, this is not kind of a classic hedge or whatever way you think of it, but like say, I'm not going to close the trade, but I'm going to freeze the situation as is. I'm going to walk away, have a coffee, go down the beach, whatever the hell, clear my head, come back, 5 candles later, whatever your time frame is, and say, okay, now where am I?
Right.
Yeah.
Now,
Options.
something that I don't think a lot of people consider is a hedge in profit.
Exactly the same. So your TP. So again, look, we've all done this. Okay, we're going. Oh, I hit my TP 1. Yeah, wonderful. And then the damn thing rocketed another 20%. Yeah.
Right.
So there's 2 ways that people think they lose money in this game. They think they lose profit. So they go, oh, I bought this thing and sold here, and then it did this.
Right.
Okay. And that is emotionally a loss, because that's potential profit. Obviously you would have had to be
right. You're leaving money on the table, which can be very frustrating. But I have tried to discipline myself to just go for manageable, more easily attainable targets. And yes, I do on occasion go back and look to, just for the education, to see how the trade would have developed or what it did afterwards. But more often than not, I don't look. I'm happy with what I got, and I move on to the next one.
Yeah. And by the way, again, the random nature of price movement, if people really analyze it, would probably horrify them and wonder why they spend hours drawing lines on charts. But anyway, put that aside. So you can do exactly the same as a stop with the TP, which is let's say I want to close 50% of my trade at TP1. We'll just have a counter trade for 50%. Again, your worst case position is that you are where you are without shutting down, and you have the ability to let the market give you more information. And if 99 times out of 100, it's just going, no, screw it. Actually, that was good. I closed both of them. Guess the news. You got exactly what you had anyway, plus a bit of funding. And again, I know I keep going on about funding and fees, but small edges add up an awful lot. So again, rather than closing partially or fully, just consider that to take a trade opposite for whatever portion that you were going to close, 100%, 50%, or whatever it is. Okay, let it sit there, and again, options, as in trading options, not trading options.
Choices, decisions, right? Not options contracts. All right, spot longs. You talk about this a lot.
I do, because, and I'm going to say that none of this, I'm going to say this, none of these are my own ideas except the silly ones. Okay, so this is stuff that I picked up over the years, and I think it was Joe 007, I could be wrong, over the years, who everybody was slagging off because he was, 20 million under on some short trade he had, until one day he tweeted, I think, I could be somebody else. He said, yeah, but I'm spot long. And I went, oh, Jesus. He said, I'm net spot long. So again, I'm a maximalist, as everybody knows. Yeah. But that's not the relevant point. I'm long an asset for a long time. Okay. And so again, as we discussed in the beginning, what I will do in what is really a long swing trade is I will fade at very significant levels. Yeah. So I go, let's start a short at 10,000, out at 20, out at 30, blah, 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 all the way up. Okay. So again, I'm now no longer naked. So if something happens, I have options. What I would say to people who are portfolio traders, I'm going to mention nobody's name, Veronica. Okay. who have large portfolios of what I would consider correlated assets. So if the market dumps, all boats sink at the same time. Right. Okay. Is to say, so it's very simple when you're trading one asset like me, which is Bitcoin. But when you're a portfolio person, you've got like a whole bunch of altcoins or whatever. Okay. Obviously, and I did suggest some kind of stop stuff yesterday, but actually what you can do is look at indexes. So you can say, look, there's the medium alt index perp on FTX. That is a ticker that reflects a large basket of medium cap alts. You've got, high cap alts, and you've got shit coins. Okay, so rather than going through this painful process of fading long positions, okay, what you can do is short these indexes at key levels. So when the altcoin market tanks, your short begins to pay. So again, you can do the same thing multi-asset with some of these index contracts. FTX is great for this. So if I'm long 10 altcoins that are mid-cap altcoins, I would do the same thing that I do with Bitcoin, which is I would have key levels up the index where I say, okay, I've got my spot long here, but now I'm going to add a short at this price and add a short at this price, and I no longer make it. So I built a hedge. Does that make sense?
That makes sense to me. Does it make sense to you guys watching in the community? If you have questions, by all means, you can post them in the chat, and we'll get to those as we get through this and keep things moving. Let's see. Yes, that's a very good idea. Makes sense. There you go. See, they do understand you, Sean.
I was always questioning if I made any fucking sense, to be honest, not whether anybody understood me. Who knows?
Same difference. Same difference. Okay. Let's see where we're at. I want to we did hedge and loss, hedge and profit. We did spot longs. Let's talk about scalps. A lot of scalpers in our community. Is it really any different?
Yes, you have lots more options, and in fact, I think the move contract chart that I showed you sent earlier today might be worth getting into, just because this is kind of the ultimate scalpers.
All right. Well,
for me, the ideal scalpers hedge.
Okay. So, we will. Do we want to? We'll jump into that one here in a second, okay? Because we're almost there. So just like with anything else, you're trying to offset and offset the losses, mitigate the risk. Fading in both directions gives you the opportunity to trap your profits or trap losses between your positions. Really important, though, to retain the relative size of your two positions, so that until you have a clear understanding what direction things are going, right? If things start going heavy in one side, that's the side you want to build on and work your way out of the other one.
Yeah. So I was working with the trader on this 6 months ago. Great mate of mine. No doubt he'll watch this, so I won't name him, Florin. And I was kind of teaching him this technique, okay? And the problem is it needs control. So as soon as you begin to go, my long is 5 times my short, okay, this begins to break down pretty fast. Okay, so if you're going to play this fading a long and short, it's really important that you keep the balance of the contracts relatively close. So for me personally, once I've got a decent separation between my long and short, I might be quite comfortable for one side to be twice the size of the other, but only for a period of time, if that makes sense.
Right.
Okay. So again, you can scalp with these kind of things, but the move contract, because we picked up a lovely example today. Thank you, Bitcoin, for being jammy, just to show how these. So the other things then other techniques for hedging. So you've got this. And I'm no expert in options whatsoever. John and Fred and a few of the other people in the group are, they're light years ahead of me. But in principle, if you think, I should also say, by the way, just to bring this back, just for something that people may be curious in, is that you have this concept of no risk, no reward. Yeah. Okay. Right. But that's actually not at all true in trading. Okay. So if somebody wants to know how to make money with virtually no risk, just do a cash and carry trade. Google it. you're not going to print 800% in a month, but you're going to print a nice amount of money for no risk. So just again, to what we're talking about managing risk on the basis that we've entered risk. Okay, but there are actually a cash and carry trade, which is, I won't go into describing it, but it's worth a Google for people. There are ways to squeeze money out of this market that entail virtually no risk whatsoever, i.e. only exchange risk, the exchange running with your coins, cash and carry and so on. Now you're squeezing out small bits. But again, if you're an active trader and you're into entering risk, this is really about how do you manage or mitigate. And again, to Dave there, yeah, basically you're spot long, you short a contango contract, easy, free money, like literally free money.
So
anyway,
Dave is asking, is cash and carry the same as the basis trade?
I've not called it a basis. I've not heard it called a basis trade. It doesn't mean, but if Dave understands, I mean, it's basically virtually all, except for perp contracts, virtually all futures contracts in this market are in a state of what they call contango, i.e. the price of the futures contract is significantly higher than the price of the underlying asset. Okay, so what a cash and carry trade is that I'm spot long the asset and I'm short the contangoed futures contract. The futures contract must expire to the price of the spot. That's how a futures contract works. And so I just pick up that differential.
Okay.
It's literally free money. Now, it's not a lot of money and it can go on forever. But again, just for people who are, extremely risk averse, it doesn't mean that there aren't trades that you can take that have virtually no risk.
Right. Very, very little. Like there's
I mean, other than the risk of holding your coins on an exchange, which is literally the only risk in that type of thing. So again, for people who are hoodlers and they look at the option of maybe lending their Bitcoin or whatever, another alternate is to look at a simple cash and carry trade. And I'll post, there's some great videos, people who explain this far better than me. I'll post them in the group just so that people understand there are actually relatively risk-free ways of squeezing a few percent out of the game.
Okay, so options contracts. This is a rabbit hole that we could spend a lot of time on, and we're not going to be able to do it in this video. But
and there are people in the group so far ahead of me on options that I'd be completely the wrong person to talk to. And Fred is leading, and John, and look, yeah, everybody knows the options experts. I will simply say that options, being another derivative product like shorting, can be very useful in constructing hedges. And indeed, I would say that most the reason that we see all of these moves on options expires is because of all of the hedging that effectively takes place, the gamma, the delta, the neutral, all the Greeks. Do you want to know? It's fucking double Dutch to me, man. Okay. Okay, but to simply give a concept of a simple options head, if I'm long spot, yes, okay, all I need to do is have what they call a married put, which is effectively an option on the downside. So again, you can use option. That is the most basic options hedging. I use derivative of options, which we're about to get to, which is move contracts, which are pre-constructed options positions, because frankly, I still don't understand options contracts very well.
Well, maybe when Fred gets some time freed up, we'll get him on here to take us through options. And there's actually, like you said, John may be a good candidate for that too. So on to one that we've touched on quite a bit today, and I know I'm eager to get a little deeper into this one, move contracts. And this is what I think is unique about this instrument is it's not directional.
Yeah, so a move contract for the options gurus out there is a US style options, long option straddle, blah, okay? But let me explain what it does in English. So on the top of the graph here, we have Bitcoin this morning, okay, doing its best BART impression for a while. And on the bottom, we have the FTX move contract.
And on the right hand side, we're not looking at price, we're looking at percentage.
We're simply looking at percentages. because it shows how this can be, considering there is a lot of complexity in this. I'm not going to go into, we're just going to explain the principles and then to understand strike prices and so on. But we had two. So the move contract effectively pays on, or effectively goes up with movement. Okay, so and movement can be up or down. So if the price of Bitcoin goes up $1,000 or down $1,000, I'm going to put in inverted commas here from strike, but we won't get to that, but it's too complicated. Okay, it's going to go up. So it's a tradable instrument that reflects volatility. And this is where you can get really almost ideal hedges once you examine the complexities of a move contract. So let's take this morning and let's take the two green arrows on the left-hand side. Okay. So Bitcoin did a nice move up, and you can see down below, moved up because Bitcoin is moving, move must go up. Okay. Right. So let's say that we're a scalper and we enter long just before the green arrow. Consecutively, we long move. Okay. So here's the beauty of this. I won my long trade, my long scalp. Okay. And my hedge paid me as well. Like, that's pretty cool.
Okay. So right. And essentially the same thing, right? So if you went up 2% on your long, and the move contract is the same 2%.
In fact, it actually moves more. But if you look at the percentages, and this is one of the kind of niceties of move and the dangers as well, is because it's an absolute move. So 2% of 50 grand is not the same as 2% of 1,500, which was the strike price. So move actually moves substantially more in percentage terms, i.e. profitability, since you're trading it, than Bitcoin does. And this is really cool. So as you can see, in the first case, we just went long Bitcoin, long move. Not only am I hedged, I just added to my P&L. Now let's come along. And
so I mean, shouldn't in a bull market, like, why don't we all have a move contract?
That's an incredible. Well, there's different contract lengths. There's some subtleties that I would be explaining for hours and hours. What I'm trying to point out is that it's a volatility that for micro scalping, short-term scalping, is just so worth spending.
Okay, so this is. Hang on a second. This is a shorter-term instrument.
This is what I would use. So, okay, there's quarter-long move contracts, there's weekly contracts, and there's daily contracts. So there's contracts that at all time frames that are of interest. For me, this is the perfect day trader scalping tool. Okay, so and today's action just gives the perfect example to show this. And unfortunately, one thing to say that if you're looking for move contracts, so I want to back test this. Once the daily move contract is closed, it's no longer available on the FTX site or on TradingView, so you can back test the idea. You have to download it and data and do a whole load of stuff. But that's why I was really glad that we got this move today, because here's an example we're going to do of 2 day trades, okay, which we've hedged really well. So again, in the first case, we've got the 2 green arrows, and let's focus on the top line, which is Bitcoin. We're long here. Our hedge is long volatility. Our trade wins, and our hedge prints P&L. We close the trades, happy days. We go out for lunch and we come back. And just before the red arrow there, we're feeling hyper bullish and we're going, screw this, I'm long in Bitcoin again, yeah? Now, if I'm not hedged, guess the news. I just handed back not just all the profits I made, plus some. Okay. Right. But if we applied the same principle of at the same time, we longed move. Now look what happened. So we lost on our primary trade, but we won on move. And in fact, we won more on move. If you look at the percentage excuse the expression, than we lost on Bitcoin.
Okay, so there's a comment from Fred who says, when move makes sense when you expect volatility, but don't necessarily know what direction. Is a move contract not directional?
It's volatility. So if the price doesn't move, move doesn't move.
Okay, so if it goes if it goes up 3% or down 3%, doesn't matter. I'm just playing 3%.
Move is going to go up, as you see in these two examples. So in the first example, price went up, move went up. In the second example, price went down, move went up.
I like this.
Yes. So and I'm probably explaining this horrendously, and Fred is absolutely right. It's actually a kind of a derivative of an option.
So we can see, if you look at the spike in the move, that's the lower part of the chart. If you look at the high point, right, that's up around 40%.
Yeah.
Notice that's actually where Bitcoin dumped the most. So
and Bitcoin only dumped 3% or 4% or whatever.
Right. So that's okay. So it is a bi-directional thing. That's
and this is the point. This is why this move makes a beautiful hedge against. So if and a lot of people in there are what I call structural traders. So you're looking at a a structure coming to an end, and you're going, well, look, I'm 70%. This thing is breaking down or whatever. Yeah. Okay. Yeah. What I do know is it's going to move. Okay, so I can place my chips on longing it or shorting it out of the structure, but at the same time I'm placing my chips on the move contract. So if it breaks in the direction that I want, it's a double win. Yeah. If it breaks in, if it breaks in the direction I don't want, well, I lose a bit on my derivatives, my perp trade or whatever you're trading. Okay, but if I do take into account all the subtlety, I'm actually going to make a lot more than I lost on the hedge. Okay. So again, things like move are relatively new, relatively low liquidity, and I'm doing the subtleties of it no benefit, because we would be here all night if I was discussing, spread from strike and all this kind of stuff. What I'm saying is that if you are a scalper, a directional scalper, this is something that you can potentially use once you understand the subtleties to add when you're right and to at least mitigate when you're wrong. And what more does a trader need?
Right. Okay. So
I don't lose any money when I'm wrong, or maybe make a few. And again, there's lots of subtleties in this. Okay, so it's not as simple as but it's just hard work to understand it. I mean, it's not really that complicated. But
yes, we're all leaving this tutorial with homework, no question.
Yeah. So again, a lot of this kind of comes down to your time frames and style of hedging. But again, I would much prefer, and I use move an awful lot myself in my algos and so on.
So Fred makes a couple of points here about options and move contracts in the chat. So anybody watching either live or on the recorded, be sure and check the chat on YouTube, and you'll see what he's talking about.
When people think of options, they're thinking of, it's a fixed price. I put this down and I wait till expire and all of this stuff. And that's going to turn off a scalper immediately. Yeah. You're going to go, what? Wait till expire. Wait for 3 months. I'm not interested. So move is a live ticker representing an underlying basket of options effectively.
And so how if move is playing volatility, how is a move contract? How does that differ from a volatility contract?
Okay. So volatility contract is similar and different. And if you were to look at the classical definition of hedging, what you're looking for is a correlated asset. Yeah.
Right.
Okay. So if you look at now again, I would use volatility contracts on longer term trades.
Okay.
Okay. So volatility contracts, if you look at that, okay, what you're seeing there is that these things tend to become an inverse of price. So if you look at again, this is the BVOL contract on FTX, okay, and we Bitcoin above and BVOL below, okay, it's equal and opposite. Now that presents excellent scalping opportunities.
How so?
Sorry, hedging opportunities. So if I'm short one and long the other, okay, I'm effectively
Canceling out any loss.
Yeah, or trapping gains again.
Right.
And now how I use these things are longer term swing. So I've trades. In fact, I'm closing one tonight that I've had open for, I think, 2 years.
2 years.
Yeah.
Yeah. 2 years, and tonight's the night. What?
It's the end of the quarter. I need to close it. It's annoying me.
Okay.
Okay.
So at least it's a psychologically based decision, not a technical one.
It's yeah. I've got some. There's one contract that I need to expire on, and then just to show you how great I am, the first part of this is a short at $13,016.
Oh, great.
But there's a long as well, so it's actually
okay.
trapped profit.
Yeah. So hopefully the long. And did you fade out of the short at all along the way?
No, well, at the time
or at least add to the long.
I took an equal and opposite position at 10.5 on a futures contract, and what that meant is that since futures contracts require no funding and the shorts paying funding, I've just been hoovering up free money on funding from trapped profit. So again, ways to think.
Okay, so you're making money. You're making money on the funding of that trade.
Yeah. So again, on perp contracts, there is an offset to funding short. Okay. So if this is a very large trade now. I mean, this is a substantial trade. Okay. And you might go, Jesus, you held a short from 13,000. What kind of an idiot are you? And I go, well, yeah, but it's hedged with a long from 10.5. The long has no funding cost. Okay.
Right.
But the short in a bull market, you're just throwing free money at me for funding. So why wouldn't I keep it open?
Okay. So it's not actually idle money. You know, that money's still making money.
Yeah, absolutely. It's again. So now I would use volatility contracts myself in that I would be continually buying BVol.
Mm-hmm.
Okay. And getting a DCA, and I will use that against other not quite year-long positions, but say, ones of many months. So right now I'm a big buyer of BVol because here's what happens: we're going to get volatile again.
Right.
Yeah.
And you say you like this instrument when you detect significant, price movement, like relative to a structure. So breakout moves, breakouts and breakdowns, things of that nature.
So what I will use this for is another form of hedge against a blow off top and subsequent crash. So right now, as you can see, BVol is cheap, and I'm buying this, once a day, whatever, and I'll just keep buying it against my spot long. Okay, and when price jams or crashes, the value of that asset will increase.
Okay.
So again, it's giving me options to make profit on a significant move up. I'm not calling the end of the bull market. I want to make that clear. I don't know. Okay, but I do know that when the last couple of bull markets ended, boy, did it just slam. Yeah.
Right.
So I'm using BVol as another hedge, longer term, just slowly accumulating it, longer term hedge against that day when the black swan comes a swimming.
All right. So this is like an airbag. This is an airbag for a stuntman from high altitude.
Yeah, again, because I'm in this game so long, I have zero intention of ever selling my spot if I can. Yeah.
Right.
Okay. And these, for people like me and who've been in this game for so long, okay, if we tank to 25K, do you want to know? I'm lucky I got in early, okay?
Right.
But that still doesn't mean I'm just going to take it lying down. Okay, so I want to go when that happens, whether it's 200 to 100 or wherever it is. Okay, I'm going to have a longer term again. So I use BVol for longer term trades for black swans.
Okay,
because if I have to wait 3 years for black swans are dangerous fucking things. Yeah, they can wipe out years of profit. So that's the way that's the way I look at them. Again,
and we were lucky on this one, or the last one, I should say, which was a year ago, March.
Yeah.
That we have been in recovery mode into bull market ever since. And it's been
absolutely. But here's the thing. And again, I'm not advocating fear. Fear is of no value in trading. I'm advocating managing risk. Ask yourself if tomorrow something happened in the world that we see another 50% down in one day. Where are you? Now, is something so bad going to happen in the world tomorrow?
I'm buying.
And I'm not, this is not a personal comment to you, okay? I've lived through, I remember, I'm sure Fred and a lot of other people remembers that in 2018, that, you know, everybody was going to be a buyer below 6K until it was below 6K, and they were all selling.
Right.
Okay, so well, I have a different view, which is, hey, I want to at least minimize my losses by hedging that, yeah? So, you know, psychology and, you know, everybody's a bull when the market's going up and everybody's a bear when it's going down. Not everybody, but in general, yeah. So, again, the reason that I say this is I'm not some form of preacher. I'm not even close to the top 10 traders in the MI group. But what I do have are battle wounds and ways of dealing with risk management that I'm saying to people, consider, because it's wonderful. Bitcoin institutions, but that you don't want to throw all of that stuff away. It would be just horrendous to throw away all of this stuff without just taking or considering or constructing whatever works for you in terms of risk management. And here are some ideas. And by the way, you could write a thesis, you could write 100 theses on hedging. I'm just trying to say, introduce some few things that I use that have worked for me at a high level. And there's a whole other world, and the options guys are absolutely, you know, a huge part of that I can't even speak to. I'm just saying what I use. And it's about, and again, if you put enough hard work in, you will probably lose some profit during the good times, okay? And you go, oh, you know, my hedges keep costing me money. And I go, yeah, but that's kind of, it's an insurance policy, yeah?
Right.
Until you need the insurance policy, you're kind of bitching about it. In this game, you will need an insurance policy at some game. And you can get very smart and occasionally reach ideal hedges where the hedges actually contribute to your profit as well. So why wouldn't you do it? But certainly do it. And again, I'm not, well, actually, I am anti-stops. Stops in this game are too easily taken out, in my opinion. The whole assets are too illiquid.
And we should quantify that for anybody who's joining in at the end. When he says he's anti-stop, he's not anti-stop. He's anti no risk management.
Right. Yeah, I use different instruments that stops
instead of
the same thing. Yeah.
Instead of stops, hedge and minimize and trap your losses and give them a chance to develop and possibly turn them into profits, or at least mitigate the risk of losing any more. Yeah. If you guys have any more questions, throw them at us now. And again, if you think of something or you're watching this in a recorded version, we invite you to follow us on Twitter and, of course, to join our global community of traders on Telegram. We'll be happy to engage with you there and address any questions that we can. Dave has a question. Funding API can be 25 to 50% of the short position. Okay, well, that's we have all of these new instruments that seem to be coming out with staking, and all the exchanges are throwing in some cases some wild numbers on some alts. Is this a good potential hedge?
I won't comment on the risks I see around this, because around that marketplace, I think the question is that if you're short a highly liquid asset, okay, so the basic funding offset for Bitcoin is 0.01% every 8 hours. Okay. So you're getting paid for holding short an offset. Now, there'll be times when shorts are playing longs, but if you average it out over an extended period of time, in a flat market, you're going to getting 0.01% every 8 hours, and in a bull run, substantially more than that. So that, again, this is why I like using the short count. The short is cover to my spot long. My spot long doesn't cost me anything. It's just sitting on a ledger. My short may be underwater, and that's okay with me because overall I'm up.
Right.
But at the same time, I'm getting this money due to all the bulls, even though people laugh at me going, you know, you've a short at 45. I go, I don't care, because you cashed out at 45. Okay, I still got my fucking Bitcoin, and I'm getting paid for it. Okay. And when we go to 77, whatever, I don't know where we're going. Okay, but however high we go up, I'm going to be adding to that.
Right.
Okay.
You'll be adding to the short.
Absolutely, all the way up. Yeah.
Because you're long from nothing.
Not quite nothing, but
well, pretty damn close.
Yeah, you know, being lucky is a hell of a lot better than being smart sometimes.
Oh, well, whatever it takes. Again, man, I want to thank you so much for the sharing of information and just so generous of you. And I'll be honest, guys, we talked about this early on, because I really feel like we should be paying Sean for this knowledge and information. And he's like, somebody passed this on to me, and I am paying it forward. And we really, really appreciate that. But if we keep doing this, we're going to come up with, we're going to give you a wallet address and start putting that out there.
No. What you do is show up in Dublin one day and buy me beer, man. It's the only payment I enjoy.
Oh man, well,
although if anybody ever shows up,
you know what would be better yet?
I always buy the fucking beer. Okay.
What would be better is if you came to Miami and joined us, because I don't know if you heard, but our mayor is turning this into Silicon Valley Southeast, and we're going to become the crypto capital. So there you go.
As soon as you can smoke on airplanes again, I'll be there.
You're not going anywhere. You're a man trapped on an island. Oh man. Well, guys, I hope you learned something out of this. Anonymous says, can you give us an update on your Anonymous
that is
know how your month of scalping has gone. Today is the last day. It's coming to an end at midnight.
I mean, just explain, my days are actually nights, so I kind of only really start working in about an hour and a half. So I haven't lost it yet. Okay, but I will let you know.
All right, so he's going to post us. He's going to give us an update at the end and let us know what his final tally was. Sean says, biggest issue is my lack of awareness of all the instruments available to me to offset risk. As a noob, my horizon is very close. Stuff is an invaluable starting point. Thanks for doing this. Hey, we appreciate you. We appreciate you watching and being a part of the community and as well. XBT, at what point of your trader career did you start hedging and using more advanced strategies? How long did it take you to understand it and get used to it?
Okay, so I probably started to really get into it in 2018, but a lot of these, and I think somebody else said it here, that like we're in a space where the derivatives market is constantly throwing up new stuff. So 2018, there was no FTX, never mind no move contracts or and options are a thing that are coming into the market. And Jesus, I have so much homework to do to even understand the basics.
The marketplace is maturing very, very rapidly.
And the range of things that are available to us as traders is ever increasing. And that can be off-putting for sure. But do you want to know it's worth the hard graft of understanding this stuff, because like we're in this game to make money. Okay.
Sure.
And so all of these things, that whether they're reducing losses or increasing gains, they roll up. And so keeping an eye on these contracts in the space in general. And again, people say to me, I have no idea. I'm the worst directional trader ever, but But what I am good at is what I call hedges. So I spend a long time examining contracts, and I would recommend anybody to do this and go, well, is there anything about the way this contract on this exchange works that I can use either in and of itself or as part of something else? So, these micro hedges, to me, just add up so fast. And again, this bull market isn't over, in my opinion. I don't know. Something could happen tomorrow. But it will end, and thinking that you're just going to close all your spot longs when it happens, I think might be a little bit naive. Right. I hope it isn't. I hope everybody gets out the fuck at the top and you all have Lamborghinis. I'm just saying that's not the way markets work, unfortunately.
Well, there's a lot. We really just scratched the surface.
Keep an angel on your shoulder. I forgot about her.
We have just scratched the surface on hedging, and there's a lot to learn. And I encourage everybody to do some research, do your own research, and study. But just like indicators, there's so much out there. It's very easy to overwhelm yourself. So take it in digestible bites, and get yourself comfortable with something before you dive into 10 other things, so that you can understand. And this is something that I think you have mastered, is understand what these instruments are and how each of them vary and what can serve you best for whatever strategy you're in. Because I think most of us, have multiple strategies going, longer term strategies versus shorter term strategies. And you're not using the same instrument for each of them. So take your time, but dive in deep, and see what works for the way that you like to trade.
Yeah, and I mean, you guys have built such an amazing community there. Like, ask. True. I mean, by the way, I'm not the founder of an all knowledge. Trust me, I know there are people in there who know 10 times more than me. But one of the things I love about crypto trading is they're a genuine community. So, like, when I started, I mean, I'll give you a simple example. When I started trading 2017 or whatever the hell it was, okay, I'd never even heard of TradingView. I got into a Slack group and I went, where'd you get the fucking charts? That's not on my Bitrex account.
Right.
And somebody went, try. I was like, oh, cool, thanks. How does that work? So, we all are in a progression here, and hopefully we can all help each other to win, because it's an easy game. Yeah. I mean, it's only about winning.
Exactly. I wish. Yeah. Well, again, guys, we appreciate you listening. We appreciate your support and encouragement in the community as we continue to develop tools. If you have not yet subscribed, we hope you will. We hope you'll subscribe to the channel here, our YouTube channel. Hope you'll do the same. Comment, like, and subscribe if you like the content, but also join us on our Telegram group and join us on Twitter, so you can stay in tune and engage with us. We are in that Telegram community literally day and night, 7 days a week, 365 days a year. We're in there engaging. And if you'd like to learn about some of our tools, including our fire charts, you can click the link below. Actually, there's several links down below that can get you to the various assets in the material indicators quiver, if you will. Remember, nothing we have said or shared or ever say, share, or do should be considered financial advice. This is a high-risk game. Do your own research, do your diligence, and never, ever risk more than you can lose. For Sean, and I'm going to say on behalf of Fred and Brad and our entire community, we appreciate you. My name's Keith Allen from Material Indicators. I'll look forward to engaging with you guys more in the Telegram group. We will have an edited version of this up on YouTube probably by tomorrow, since it's late in the day here. Quick check for some comments at the end. Thank you, guys. Thanks, Sean. Thanks, Veronica. Yes, it has been a pretty epic MTF day for a lot of folks today. We appreciate you guys, and look forward to talking with you some more in our Telegram group. Thanks again, Sean. Really, really appreciate everything that you have done to help us do this, and look forward to doing more with you, man.
Take it easy, guys.
Have a good one.
Cheers.